Chart Patterns Introduction. Overview. Let's discuss how to put on trades according to chart patterns. First, a few facts to keep in mind. Chart patterns can be traded on all time frames: intraday, swing on long-term investment. If you're taking the 5, 10, or 15-minute charts, you can be trading a continuation or reversal chart pattern on an intraday basis. If you're looking at a longer time frame, like the daily, weekly, or even monthly, you're looking at a long horizon, but it will still work because emotions and demand are universal laws. Chart patterns must always be analyzed in the context of a trend. It is very important for you to see which trend is currently prevalent in the stock. There are two types of chart patterns: reversal chart patterns, symmetrical triangles, flags, ascending or descending triangles, gaps; and continuation chart patterns, head and shoulders wedges, double tops or triple tops, wolf waves. There are more patterns, but most of them are basically variations of these, so there's no point learning how to identify all of them without actually knowing how to trade them. Like we've seen before, it's more important to learn a few things and master them than try to be a jack of all trades. A continuation, like a symmetrical triangle, is expected to continue the trend. In a reversal chart pattern, we expect the market to reverse the trend it's currently in. If you see an inverted head and shoulders in a downtrend, you're expecting to buy, because you're expecting the trend to now shift from down to up. We'll go through each and every pattern, how to identify them, how to put up trades using them. Always remember, it's the money management that will save you and bring you profits. Breakdown. Technical traders use the price history of any asset and the price patterns that form as a basis for making trading decisions and analysis. This is called technical analysis, a technique that uses the price chart of an asset as a key determinant in forecasting where the price will go next. Price charts are highly visual, showing where a stock price has been in the past, the price's current trajectory, and how volatile the price movements are, and whether the stock has a lot or little interest in it. What can you learn from charts? Chart patterns are a field of study within the larger field technical analysis. Chart patterns are geometric shapes created by the price movements of an asset, such as a stock, currency, or commodity. These geometric shapes provide a context for how the asset is moving right now, and the direction and magnitude of the price moves that may be forthcoming. Chart patterns are a key tool in the technical trader's arsenal. The following lessons will cover the main types of chart patterns, including how to trade them and what insights they provide into current and future price movements. The size of a chart pattern and where it occurs within a trend provides clues as to how big the next price move will be once the chart pattern completes. When the price finally breaks out of the chart pattern, completion, this indicates the direction the price is likely to continue moving. Therefore, chart patterns are useful tools for any trader, whether they trade the patterns or use them for analytical purposes. Reversal patterns versus continuation patterns. Like we've seen, reversal patterns signal an end to the trend that was in place prior to the chart pattern forming. For example, if the price had been trending higher and then a reversal pattern forms and completes, the uptrend is likely over. Continuation patterns signal the continuation of a trend. If the price is moving lower and then a continuation pattern forms and the price breaks out, completes, in the trending direction, then that downtrend is likely to continue. Traders highlight chart patterns by using trend lines. Trend lines are drawn along high and low points on the chart. These trend lines are then used to signal when the price is breaking out of or completing the pattern. There is subjectivity involved in drawing trend lines, which means that chart patterns are not an exact science. One person may see a pattern someone else does not, or draw their trend lines in a different way, leading to a different pattern or breakout point. Such differences affect the performance of trades based on the patterns. Even though there is subjectivity, new traders should not be discouraged if they don't immediately find trading chart patterns profitable. With practice and experience, traders will develop skills which aid them in assessing which chart patterns to trade, and how, and which patterns to leave alone. There are a number of chart patterns to be aware. Each provides its own insight into where the price could go in the future, and how far. Certain patterns can be used as a trading strategy, with an entry point, a stop-loss level which helps control risk, and a target price for locking in gains. Traders may alter these techniques based on their own experience or market observations. The bottom line. Traders use chart patterns to help determine which direction the price is going, and potentially how far it could go. Chart patterns like head and shoulders, triangles, cup and handles, double or triple tops and bottoms, flag pennants, rounded bottoms, and wedges all provide entry points, stop loss levels, and profit target estimates, making them almost complete strategy. To trade these patterns as a complete strategy, traders incorporate the patterns into their trading plan, and will also determine the proper position size to take on each trade. Gaps may be used as entry or exit points, depending on whether the gap signals a continuation of the trend or a reversal, but also may be used for analysis purposes. The insight gained from watching a chart pattern or gap unfold may lead to taking advantage of another trade based on a different strategy.